Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 20th of April. Let's dive into the week's top market news. European markets navigate shifting forecasts and cautious central bank signals. The Pan-European Stocks Europe 600 index concluded the last week with a 1.91% increase in local currency terms, buoyed by investors digesting recent corporate earnings and easing geopolitical tensions following Iran's pledge on Friday to keep the Strait of Hormuz open. This positive sentiment rippled across major European indexes. Germany's DAX led the charge with a robust 3.77% gain, followed closely by Italy's FTSE MIB, which rose by 2.65%. France's CAC 40 index also experienced a solid climb of 2.00%, while the UK's FTSE 100 index recorded a more modest increase of 0.63%. Amid these market gains, policymakers at the European Central Bank, ECB, have signaled a cautious approach, emphasizing they are in no rush to implement interest rate hikes. François Villeroy de Galhau, the head of the French Central Bank, explicitly stated that betting on an April hike would be premature, stressing the need for more comprehensive data regarding the impact on underlying inflation and consumer demand. Concurrently, the International Monetary Fund, IMF, has tempered its economic outlook for the region, citing the ongoing conflict in the Middle East and the looming threat of a severe energy crisis. The IMF downgraded its 2026 economic growth forecast for the Eurozone to 1.1%, down from the 1.3% projected earlier in January. The UK faced an even steeper downward revision, with the IMF cutting its 2026 growth estimate from 1.3% to 0.8%, the most significant reduction among all G7 nations. Despite the tempered broader forecasts, recent macroeconomic data paints a nuanced picture of regional performance. In February, Eurozone industrial production experienced an unexpected rebound, growing by 0.4% month-over-month and recovering from a 0.8% contraction in January. This resurgence was largely driven by robust output increases in Ireland, Finland, and Sweden, which helped offset production declines in Malta, Luxembourg, and Greece. Meanwhile, inflationary pressures persist in specific sectors, as evidenced by German wholesale prices surging 4.1% year-over-year in March. According to data from the country's Federal Statistical Office, this spike was primarily fueled by the geopolitical impact on energy and metal markets, with wholesale prices for non-ferrous ores, metals, and semi-finished metal products skyrocketing by 48.4%. Interestingly, this sharp increase contrasts with wholesale prices for many food categories, which actually fell over the same period. Across the Channel, the UK economy demonstrated unexpected resilience in February, expanding by 0.5% month-over-month. This performance significantly outpaced both the projected 0.1% growth and January's 0.1% rate, bolstered heavily by administrative and support service activities, even as contractions were noted in the construction, accommodation, and food service sectors. Now our insight into alternative markets, navigating post-acquisition integration, strategic choices for value creation, inorganic growth, driven by mergers, acquisitions, and strategic investments, has become a fundamental pillar in the investment theses of multiple financial and industrial operators. Companies often face the aftermath of several rounds of institutional capital injections or having acquired various other target companies, inheriting deeply heterogeneous IT and operational ecosystems in the process. The acquisition process can inevitably lead to the simultaneous management of different CRM platforms, ERP systems, and other duplicated corporate tools. Although the default integration strategy often consists of consolidating the acquired entities onto common informational and operational systems, this approach can prove highly disruptive. In cases where the target companies do not present significant operational overlaps, neither the financial investment nor the degree of disruption required for their total integration may be justified. This challenge arises across organizations of every size and industry, from large manufacturing entities grappling with the complexity of unifying multiple business systems following a series of acquisitions, to regional distribution companies engaged in the consolidation of local operators. Regardless of scale, balancing operational efficiency with the costs and disruptions stemming from integration represents a primary critical issue for management teams. System integration can certainly offer crystal clear advantages, such as improved visibility across the entire organization, leaner operations, more robust data governance, and a more consistent customer experience. However, it entails tangible trade-offs and impacts on the income statement, P&L. Integration initiatives can prove burdensome in terms of CapEx and OpEx, prolonged over time, and highly impactful on business continuity. In select cases, forcing uniformity on distinct business models or regional operations can reduce flexibility and effectiveness at the local level. The key for strategic leadership lies in determining with mathematical precision and industrial logic when integration will lead to an actual increase in enterprise value and when, conversely, it will simply introduce unnecessary inefficiencies. Integrating systems following an acquisition often represents the most linear path to realizing the synergies estimated during the due diligence phase and establishing a unified operating model. When rigorously planned and executed, integration reduces redundant costs, eliminates duplicated processes, and creates a single centralized data source to support decision-making based on reliable metrics. Furthermore, it accelerates corporate cultural alignment by enabling consistent data flows, standardized reporting, and optimal sharing of commercial information within the newly combined entity. From a purely strategic standpoint, integration allows the acquiring company to extend its governance, compliance, and cybersecurity frameworks to the target, mitigating systemic risks and enhancing internal control activities. Integrated systems structurally support cross-selling, unify sales channels, and ensure operational scalability, fundamental levers for increasing EBITDA margins. In certain circumstances, integration also strengthens the company's future positioning ahead of a subsequent exit strategy, as a fully integrated entity is significantly more attractive to future investors, whether they are private equity funds or strategic buyers, who attribute a high premium to operational cohesion, the reliability of data structures, and the maturity of IT environments. On the other hand, integration is not an axiom always synonymous with value creation. In many circumstances documented by historical market data, the costs, technical complexity, and operational disruptions associated with consolidation can far outweigh the expected benefits, particularly when the acquired entity already boasts excellent profitability metrics within its own autonomous ecosystem. A forced integration risks paralyzing productivity, delaying value capture, and diverting management's attention from strategic revenue growth to focus on resolving IT issues. For M&A transactions aimed primarily at acquiring human capital, product innovation, or rapid expansion into new markets, maintaining separate systems and processes can preserve the agility, execution speed, and entrepreneurial culture that justified the acquisition price. Decoupled systems can also drastically reduce execution risk in the short term, especially in the presence of significant divergences in legacy architectures, database quality, or regulatory compliance standards. Finally, There is a precise strategic and financial rationale in favor of a conservative approach if the acquisition is conceived with a view to a short to medium-term divestment, or as an independent growth vehicle. In these scenarios, avoiding deep integration allows for maintaining a high degree of flexibility and minimizing future carve-out costs. Maintaining the operational independence of the acquired company enables leadership to act promptly should macroeconomic conditions or interest rates favor a liquidity event, while preserving the ability to present the company to potential buyers as a clean, standalone asset devoid of structural complexities that could depress its final valuation. The success of post-merger integration therefore lies in the analytical assessment of each organization's unique operational and technological landscape to determine the optimal path, ensuring that consolidation choices are always subordinated to the calculation of return on investment, ROI, and the generation of long-term cash flows.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.